Trade wars are rarely won, but they can certainly leave lasting economic scars. As Donald Trump prepares to escalate his protectionist policies, the global economy stands on the precipice of renewed uncertainty. The latest round of tariffs targeting Canada, Mexico, China, and the European Union is not merely an extension of previous policies. It marks a sharp intensification of economic nationalism that could reshape global trade relationships and supply chains for years to come. One of the most immediate concerns is Trump's decision to reinstate 25% tariffs on Mexico and Canada, effectively undoing previous suspensions and further complicating North American trade. These tariffs, originally paused under diplomatic negotiations, are set to return alongside additional duties on steel, aluminum, and potentially European imports. Trump has also signaled an aggressive stance toward China, floating the idea of new 10% tariffs on Chinese goods while pressuring Canada and Mexico to join the US in imposing similar measures. This approach lacks coherence, not just in its economic logic, but in its political execution. The administration has offered shifting justifications, from combating fentanyl to enforcing so-called reciprocal trade. But reciprocity in Trump's context seems to mean unilateral economic aggression, rather than genuine efforts to level the playing field. Perhaps most striking is the administration's demand that Canada and Mexico form a Fortress North America, a term used by Treasury Secretary Scott Bessent, urging them to align their trade policies with Washington's hardline stance on China. Such a move would not only damage Canada's and Mexico's independent trade relationships, but could also undermine existing agreements like the USMCA, which was supposed to bring stability to North American trade after years of uncertainty under Trump's first administration. Tariffs, by design, are a tax on businesses and consumers. The Trump administration continues to frame these measures as a strategy to boost domestic industries. Yet history and empirical evidence suggest otherwise. The 2018 to 2019 trade war with China demonstrated that tariffs largely resulted in higher costs for American consumers and businesses, rather than reshoring production. Supply chains adjusted, but not in the way the White House had anticipated. Companies did not move operations back to the US en masse, but rather diversified into other low-cost markets like Vietnam, India, and Mexico. This time, the risks are even greater. North America's tightly integrated supply chains, particularly in the automotive sector, rely on smooth cross-border trade. A 25% tariff on Canadian and Mexican imports would sharply increase production costs for US manufacturers, leading to higher vehicle prices and potential job losses. Given that automakers like Ford, GM, and Tesla rely heavily on components sourced from Mexico and Canada, these new tariffs could disrupt production timelines and force companies to seek alternative, and likely more expensive, supply chains. Moreover, the renewed threat of steel and aluminum tariffs could place additional strain on industries already grappling with inflation and fluctuating commodity prices. While US steel producers may see short-term gains, the broader manufacturing sector, especially construction, aerospace, and heavy machinery, will likely suffer from increased input costs. The international response to Trump's trade policies is as critical as the policies themselves. If Mexico and Canada choose to retaliate, the North American trade environment could quickly deteriorate into a tit-for-tat economic conflict, harming industries on all sides. During Trump's first presidency, retaliatory tariffs targeted US agricultural exports, particularly soybeans, dairy, and pork, causing severe financial stress for American farmers. If history repeats itself, agricultural exports could once again become collateral damage in an escalating trade war. Beyond North America, Trump's proposed tariffs on European imports threaten to reignite tensions with the EU, a major trading partner. European leaders have already signaled they will not hesitate to impose countermeasures if the US proceeds with broad tariffs. The implications of such actions could extend far beyond immediate economic losses. Tariff disputes could erode diplomatic ties at a time when global cooperation is crucial for addressing economic recovery, supply chain resilience, and geopolitical stability. China, meanwhile, is likely to take a more calculated approach. Having adapted to previous trade confrontations, Beijing could opt for retaliatory measures that target key U.S. industries, such as technology, semiconductors, or even financial services. Furthermore, Trump's strategy could inadvertently push China closer to other global economic players, including the EU and emerging markets, thereby diminishing U.S. influence in global trade. Trump's tariff-heavy trade policy is driven more by domestic political considerations than by economic rationale. The former president continues to appeal to a protectionist voter base that sees tariffs as a means to restore American industrial strength. However, this approach overlooks the reality that global trade is no longer a zero-sum game. It is deeply interconnected, and protectionism often leads to higher costs rather than sustained economic growth. A major concern is that Trump's trade policies appear to be implemented on a whim, without a clear long-term strategy. Business leaders and investors thrive on stability and predictability, neither of which is present in the current trade environment. Market reactions to previous tariff announcements have been swift, with stock prices of major multinational corporations experiencing volatility whenever new duties are introduced. The uncertainty surrounding trade policy discourages long-term investment, further complicating economic growth prospects. One of the unintended consequences of Trump's tariff escalation is its impact on monetary policy. Inflation remains a key concern for the Federal Reserve, and tariffs function as an inflationary force by raising the cost of imported goods. If Trump follows through on his trade threats, the Fed may find itself in a difficult position, forced to balance inflationary pressures against slowing economic growth. An environment of rising inflation and economic stagnation, often referred to as stagflation, could emerge if tariffs disrupt supply chains while simultaneously increasing consumer prices. Additionally, Trump's frequent criticisms of Fed Chair Jay Powell and his calls for lower interest rates further complicate the central bank's decision-making. If the Fed succumbs to political pressure and cuts rates prematurely, the risk of inflation spiraling further out of control increases, placing additional strain on the broader economy. As Trump moves forward with his protectionist trade agenda, the global economic landscape faces heightened uncertainty. The return of broad tariffs, coupled with unpredictable policy shifts, threatens to disrupt North American trade, escalate tensions with key allies, and stoke inflationary pressures at home. While Trump's base may rally behind his aggressive stance, the broader implications of these policies suggest a more complicated reality, one where businesses, consumers, and economic stability pay the ultimate price. For now, the world watches as Trump's trade policies unfold. The question is not just whether tariffs will be implemented, but how markets, policymakers, and international partners will respond. If history is any guide, protectionism rarely leads to long-term prosperity. The risk, however, is that by the time this lesson is learned, the damage may already be done.